Hey, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I want to discuss 3 popular high-yielding REITs offering dividend yields in excess of 10%. These REITs are very often recommended on platforms like YouTube, Seeking Alpha, Substack, and yet I think that they are very bad investments. So I want to warn you against them. Then towards the end of the video, I will also discuss what I view as much better alternatives, so make sure to stick till the end. Okay, so the first REIT that I would avoid is called AGNC Investments, ticker symbol AGNC. This is a very popular mortgage REIT, and it's so popular mainly because it's offering a 16% dividend yield. Investors seem to think that this dividend is sustainable and that the REIT will enjoy solid growth even in the coming years, leading to strong total returns. But I wouldn't be so confident. I think that the business model of this REIT is extremely speculative. It's completely dependent on macro factors like the level of interest rates, the directions, the size of spreads, how they evolve over time. These macro factors are very difficult to predict, and yet they can make or break the business of AGNC. And because of that, it feels like investing in AGNC feels more like speculating than investing, in my opinion. It feels like a coin flip since these macro factors are so difficult to predict. If you don't believe me, we can just look at the past track record of the REIT. Over the past 10 years or so, the REIT has consistently failed to predict major turns in these macro factors, and as a result, it has only earned very low single-digit total returns to its shareholders, resulting in significant market outperformance. And so ultimately, there's no point in earning a 16% dividend yield if at the same time your share price is gradually declining in value. In the end, what matters is the total return. And in the case of a REIT like AGNC, they've been really poor historically, and I expect this streak of underperformance to likely continue going forward. The REIT has also cut its dividends several times over the last 10 years, again, simply because it failed to predict these major turns in the macro environment. And so, yeah, I just don't see the point. Seems very speculative at the very least to me. The second REIT I would avoid that many of you keep asking me about on my YouTube channel is called Global Net Lease, ticker symbol GNL. On the surface, it may seem like an interesting opportunity because it's a net lease REIT, so it enjoys long leases with annual rent escalations. Tenants are typically responsible for property expenses, including even the maintenance. The REIT owns mostly industrial-based net lease properties that could grow in demand as a result of e-commerce, onshoring, the AI revolution. And yet the REIT is trading at a historically low valuation, a much lower valuation than most of its peers. It's offering a dividend yield in excess of 10%, it's trading at 7 to 8 times FFO. And just recently, the REIT went through an internalization of its management, which on paper should better align the interest between the shareholders and the management. So on the surface, I understand why it may seem appealing, and yet this is one of my least favorite REITs in the entire market. I don't plan to ever buy this REIT, and there is the main reason for it is its management. I just don't trust them. This REIT was previously externally managed. Many of the same people are still involved with the REIT. I think that has historically suffered very significant conflict of interest. This is very clear if you just look at the chart of its share price and the gradual increase in share count over time. You'll see that the management has consistently issued equity at highly dilutive prices, and so this has hurt the performance of the REIT over time. It went public over 10 years ago, and the REIT still hasn't earned a positive return to its shareholders, even including the dividend, still earning a negative return so far, which just, in my opinion, the results speak louder than words, and the results couldn't be worse. I mean, how can you mess it up so bad that over such a... Sorry, the light just went off. I'm in a WeWorking office, and I'm the only one here on the weekend. But how can you mess it up so bad that over a 10-year time period in real estate, you don't manage to earn a positive total return? And Global Net Lease has managed to do that. Since going public, they've also cut their dividend many times, I think about 5 times. And today, yes, the properties are relatively attractive, but because their cost of capital has been so high, they've been forced to buy mostly higher cap rate properties. So and when you're buying higher cap rate properties, you're not getting a higher cap rate for nothing. Typically, it means you're taking higher risk. So these are properties often in secondary, tertiary markets. They don't have really good locations. They might be a bit older. The tenant might be a bit weaker. And they also have quite a bit of leverage. The LTV is in the 40 to 50% range, so it's quite a bit higher than most of its net lease peers like Realty Income, Agro Realty, and so on. Their dividend payout ratio is too high today, so I think another dividend cut is likely coming sometime over the next year. So yeah, I think that this is likely to remain a value trap. I don't think that the internalization of the management changes the story, because a lot of the same people are still involved, and I personally don't trust them. That's my personal opinion. And so for this reason, I don't expect you to buy the REIT anytime soon. The REIT always seems to trade at a discounted valuation and always offers a high dividend yield, and yet it keeps disappointing time and time again. I'm not interested in it. Before I go into the third REIT, can you please do me a huge favor and click the like button, subscribe to your channel. If you think that this type of videos are valuable to you, we'll also highlight some REITs that perhaps you should be cautious about. I think that if you want to outperform the market, just as important to avoid losers as identifying the winners. And therefore, I think that these videos can be quite useful. But let me know what you think in the comment section below. The third REIT I would avoid that's very popular is called Arbor Realty Trust, ticker symbol ABR. Again, this is a mortgage REIT. It's very popular because it's offering a high dividend yield. And unlike many other mortgage REITs, historically Arbor has been quite well managed. It has managed to gradually grow its dividend in nearly every year. The management is shareholder friendly. They've done a pretty good job. But the problem with this REIT is that it's heavily invested in multifamily today, and it has quite a bit of exposure to development projects. And yet multifamily today is heavily oversupplied in many markets. Rents are stagnating or declining. Cap rates have expanded as a result of the surge in interest rates. And as a result, I think that a lot of its loans are today very close to defaulting or already underwater. And I think we're going to see more credit losses over the coming quarters, next year or two, unless they get lucky and we get very steep rate cuts. So again, it makes it feel quite speculative since you're relying so much on the rate cuts. At the same time, the REIT itself is quite heavily leveraged. So in a way, it's a leverage play on these potential credit risks. And it's I've been pointing this out now already for a little while, for over a year, and recently the REIT ended up cutting its dividend by over 30%. So I was correct. I just think that this is still just the problem starting to surface. I think that we're going to see more of these troubles over the coming quarters, and therefore, yes, the dividend yield is still relatively high. The REIT overall should do relatively well over time, but it's just too risky in my opinion, and I think that ultimately there are other REITs in the market that are also discounted, and yet they offer a better path, a more likely path to future outperformance. So no interest in Arbor Realty Trust either. If I was going to invest in it, I will probably look at its preferred equity, but even its preferred equity feels quite risky in my opinion compared to some other alternatives. Okay, so let's now discuss a few better alternatives in which we are currently investing at High Yield Landlord. By the way, if you're not aware, High Yield Landlord is the biggest REIT newsletter online. In there, we highlight my personal REIT portfolio. We share all my transactions in real time, and also we share a lot of exclusive REIT CEO interviews and other high quality research. So if you want to check it out, make sure to click on the first link in the description of this video. This will redirect you towards our landing page where you'll be able to sign up for a 2-week free trial. Okay, so at High Yield Landlord, we tend to look for REITs that are undervalued but on high quality assets, have strong balance sheets, shareholder friendly management teams, but typically they're undervalued because they're undergoing some type of temporary issue. And so one thing that we like to look for as basic rule of thumb is that we want to be able to earn double-digit total returns from the yield and the growth combined together. And so a good example of that would be if you're earning a 5% dividend yield and your REIT is growing by 5% FFO per share annually, you're getting to a 10% economic total return, assuming that the valuation multiple remains intact. And then on top of that, we wish to get some additional upside from multiple expansion as the REIT resolves some issues. Perhaps it's too heavily leveraged, so it needs to pay off some debt. Maybe it's dealing with a few troubled tenants, but as it perhaps releases this space to other tenants, it can earn a higher valuation multiple. There's many potential catalysts to achieve this, but so we're looking to earn a roughly 10% annual return from the yield and the growth, and then we want some additional upside to potentially reach closer to 15% annual total returns. And so two good examples of that I think are likely to achieve this over time in our portfolio are Kite Realty Group, ticker symbol KRG, and the other one will be Sila Realty Trust, ticker symbol SILA. I'll start by discussing Kite. This is a retail REIT that owns mostly grocery-anchored, service-oriented strip centers in rapidly growing Sunbelt markets. Historically, the REIT has enjoyed some of the fastest same property NOI growth in the entire retail peer group. It also has the least leverage, so a very strong balance sheet, even less leverage than A-rated peers like Federal Realty Trust or Regency Centers. But despite that, it's today trading at one of the lowest valuations in its peer group, and I think that this is because of some temporary issues. It's dealing with more tenant bankruptcies this year than most of its peers. It's just unlucky. It was more heavily exposed to a few key retail tenants. But I think that this is a case of short-term pain for long-term gain. It's preventing the REIT from growing this specific year as it's dealing with these tenant defaults. But it's going to give it an opportunity to now get back this space and release it at much higher lease rates, because these leases were already quite a bit below market. So it's giving it an opportunity to increase rents, to improve its tenant roster, and return to growth in 2026, which I think will then lead to some multiple expansion. The REIT is offering a roughly 5% dividend yield. Over the long run, we expect it to grow by about 5 to 7%. Its FFO per share, that gets you to double-digit total returns. And then on top of that, we expect some multiple expansion. Today it's trading at 11 times FFO. If it gets closer to 15 times FFO, which would be right in the middle of its peer group, which I think is warranted, again, given that it has a stronger balance sheet. Historically, has been growing faster. It's exposed to rapidly growing Sunbelt markets. So if it gets back to 15 times FFO, that would unlock another 25 to 30% upside. If you think this is going to happen over 3 to 5 years, that adds another 5 to 10% to the annual returns, bringing you to 15 to 20% annually going forward. And so that makes it quite attractive, and it's the reason why we own it in our core portfolio at High Yield Landlord. Then the second REIT I want to discuss shortly is called Sila Realty Trust. This is a relatively new REIT that listed about a year ago. We started investing very shortly after the listing when we discovered it, because we thought that it was heavily discounted. Back then when we bought shares, it was trading at about $22 per share. Now it has already risen about 20%, it's trading at about $26. But even at these levels, I think it's very attractive. The REIT is focusing on medical office buildings that are enjoying steady rent growth, high rent coverage ratios, so we see relatively little risk of tenant disruption. The REIT has very little leverage, and that's a key part of our thesis, as we think that the REIT will be able to now take on more debt to buy additional properties at large positive spreads over its cost of capital. And so we think that the combination of rent growth plus the spread investing from additional investment should allow the REIT to grow its FFO per share by about 5 to 7% annually. So a similar rate as a Kite Realty Group. And yet the REIT is today also offering a 6% dividend yield. So you're adding the 6% yield with the 5 to 7% growth. And again, you're getting to well in excess of 10% annual returns, which is our basic threshold that we're seeking to achieve. But then on top of that, the REIT is trading at just around 12 times FFO. We think that there is a bit of upside, perhaps not quite as much as in the case of Kite Realty Group, but we think that it could re-rate at closer to 14, 15 times as well. And so that would add another 20-ish% upside from here. Again, that should get you to the 15, 20% annual total return range. And to be clear, just because this is our expectations and this is the basic math, doesn't mean that all of these investments are going to be successful. Sometimes risk factors will play out and we'll end up losing some money on one of these REITs. But that is why you need to diversify your portfolio. In our core portfolio, we hold these two REITs, so Kite Realty Group and Sila, but combined together, they make up only about 8% of the portfolio, I believe, today. I think it's actually quite a bit high. No, sorry, it is closer to 10% because we built so much our position in Sila over the past month when it dipped. But in any case, that shows you that our portfolio is vast and well diversified. We hold over 20 other REITs in that portfolio, each focusing on different property sectors. Each has different catalysts, and so that ultimately allows us to greatly improve the risk to reward of our portfolio. Quick reminder, if you want to access it, you can join us for a 2-week free trial. You won't be charged anything the first 14 days. You can just join us, see our portfolio, read our research, see if you like it, and if you don't, you can just cancel. No question asked. You won't be charged a penny. Finally, once more, if you could please click the like button, subscribe to the channel, helps me tremendously. Thanks so much in advance. Let me know in the comment section below what other REITs I should cover next. See you at my next one. Bye bye.